A few months ago, I was preparing for a client meeting and walked through two scenarios I use all the time when explaining basis planning. Client A and Client B. Both are retired, both in their early 70s, and both want to give their kids $500,000 worth of stock they've held for decades. Client A says, "Let's do it now. I want to see them enjoy it." Client B says, "I'll hold it and they can inherit it when I'm gone." Here's how those choices typically play out. Client A's son sells the stock and ends up owing about $95,000 in capital gains taxes. Client B's daughter, when she inherits, she pays zero. Same asset, same generosity, same intentions. But one decision can quietly cost a family nearly 6 figures. And here's the twist. In the right situation, Client A actually made the correct decision. Today, I'm going to show you exactly how to make this decision for your own family. Because whether you are sitting on Apple stock from 2010, a rental property you bought 20 years ago, or a family business that's grown in value, getting this wrong can quietly cost your children $100,000, $200,000, even $400,000 in taxes they never needed to pay. And the worst part, once you make the gift, you can't undo it. So let's make sure you get this right. First, you need to understand the simple concept, basis. Basis is just what you originally paid for an asset. If you bought something for $50,000 and it's worth $400,000 today, the difference, $350,000, is the gain. And when that asset is sold someday, someone is going to pay capital gains tax on that $350,000. And the entire question is this: who should pay that tax? You or your kids? And when? If you gift an asset during your lifetime, your child receives your basis, not the current value. That's called carryover basis. So if you bought Amazon stock years ago for $100,000 and today it's worth $500,000, here's what happens if you gift it now. Your daughter receives the stock worth $500,000, but her basis becomes your basis, $100,000. When she sells, she pays capital gains tax on the full $400,000 of appreciation. At a 20% federal rate, plus 3.8 net investment income tax, that's roughly $95,000 in taxes. She receives a general $500,000 gift and a 95% tax bill along with it. This is where so many well-intentioned families stumble. They want to help their kids today, but the gift ends up creating a completely avoidable tax burden. Now, let's look at the opposite choice. What happens if you don't give the stock and instead hold it until you pass away? When your daughter inherits it at your death, something powerful happens. The IRS steps up the basis to whatever the asset is worth on the date of your death. Let's use the same asset to keep comparison clean. You bought Amazon for $100,000. At your death, it's worth $500,000. Your daughter inherits it with a new basis for $500,000. If she sells it the next week for $500,000, her taxable gain is zero. Her tax bill is zero too. Gift during life, $95,000 tax. Inherited death, zero tax. Same asset, same value, $95,000 in difference. This is step up in basis, and it's by far one of the most powerful wealth transfer tool in the entire tax code. So if step up in basis is so powerful, why would anyone ever gift during their lifetime? Well, there are situations where gifting now actually makes a lot of sense. One situation is when your estate exceeds the exemption. If your estate is large enough to trigger federal estate taxes, $15 million per person or $30 million per married couple, then the math changes completely. Estate tax is 40%. Long-term capital gains tax is roughly 24% when you include the net investment income tax. So if you are facing estate tax, it can actually be better to gift appreciated asset now, even with carryover basis, because you are trading a 40% tax for a 24% tax. Here's what that looks like in real numbers. You give $2 million of stock with $500,000 of gain. Your kids will eventually pay about $120,000 in capital gains, but you just removed $2 million from your estate and saved $800,000 in estate taxes. Net savings, roughly $680,000. For families with estates over the exemption, gifting now can be incredibly powerful. And that doesn't even include potential state estate taxes if you live in a state that imposes them. Another situation is when the asset hasn't appreciated much. If there is little or no gain, carryover basis simply isn't a big deal. For example, you bought a stock for $100,000. It's now worth $115,000. You gift it to your son. His basis is $100,000. When he sells it $115,000, he pays tax on $15,000 of gain. That's about $3,500 in taxes. Not a big deal. In this case, gifting now is perfectly fine. You are moving asset out of your estate without creating a meaningful tax burden. And here's another one, when the asset is going to charity. If you are charitably inclined, gifting appreciated asset, either directly to a charity or through a donor advised fund, is one of the most tax efficient moves you can make. You avoid capital gains entirely. The charity receives the full value, and you get an income tax deduction for the fair market value. This is especially powerful if you're in a high income year and want deduction now. For most families I work with, those with estates well under the exemption, holding onto appreciated assets and letting your kids inherit them is usually the smarter move. And there are a few situations where waiting isn't just better, it's dramatically better. One common scenario is highly appreciated assets with no estate tax problem. This comes up constantly. If your estate is under the 15 million exemption, you own assets with significant gains, and your kids will eventually sell them, waiting for step up is almost always the better move. Here's a real example from my practice. One of my clients owns a rental property, bought it for $276,000 years ago, and today it's worth about $700,000. That's over $400,000 of unrealized gain. If they gift it now, the kids owe roughly $100,000 in capital gains taxes. If they wait, the basis resets to $700,000 and the tax bill disappears. Waiting saves $100,000. Another situation where waiting makes sense is real estate with depreciation. Rental properties come with a twist: depreciation recapture. If you've been taking depreciation deductions on a rental for 20 years and you gift it during your lifetime, your kids inherit your original basis, your accumulated depreciation, and the recapture tax liability that comes with it. Recapture is taxed at 25% federally, plus state tax, so that can become a very expensive gift. But if you hold the property until death, step up wipes out both the capital gain and the depreciation recapture. It simply disappears. For most rental properties, unless you're dealing with a significant estate tax concern, waiting is almost always the better long-term strategy. And here's the big one: stock bought decades ago. This is where the tax difference gets huge. Think Microsoft in the 90s, Apple in 2005, Amazon in 2010. Anything you've held for decades with massive appreciation. If you give these while you are alive, your kids inherit your original basis and your gain. But if they inherit them when you pass away, they get a full step up in basis. And if they sell, their taxable gains is zero. This is where the difference between gifting now and waiting can easily be $250,000 or more. Now, let me show you where families get into trouble with, because I see the same basis mistakes over and over, and they are almost always made with good intentions. These are the mistakes that quietly cost families tens, sometimes hundreds of thousands of dollars. Mistake number one: gifting real estate to avoid probate. I see this all the time. Parents add their kids to the deed of the house or rental property thinking, this will keep things simple, this will avoid probate. And yes, it avoids probate, but it also creates a massive capital gains problem. If your home has $500,000 of appreciation and you add your kids to the deed now, they inherit your basis. When they sell after you are gone, they pay tax on that full $500,000 of gain. If you had kept the property in your name, they would receive step up and owe zero tax. You saved a few $1,000s in probate fees and cost them $120,000 in taxes. And on top of that, you've made a taxable gift that may need to be reported on Form 709, something your CPA and estate attorney should be involved in. Mistake number two: adding children to investment accounts. Parents add their adult children as joint owners on brokerage accounts for convenience, or to help pay bills, or just because they think it's the right thing to do. But the moment you add them, the account loses step up and switches to carry over basis. You didn't just add the name to the account, you added a future tax bill. Mistake number three: transferring highly appreciated stock during life. This one shows up all the time. You're feeling generous. You want to help your kids now, so you transfer that Microsoft or Apple stock you've held for 20 years. Generous? Absolutely. Tax efficient? Not even close. If you bought the stock for $50,000 and it's now worth $500,000, you've just handed them a $450,000 gain and a six-figure tax bill. Had they inherited it instead, their taxable gain would have been zero. Mistake number four: forgetting about state taxes. Federal capital gains tax is only part of the story. State taxes can be just as brutal, and in states in California, even worse. California adds up to 13.3% on top of federal tax. So that $400,000 gain we talked about earlier, federal tax roughly $95,000. Add California tax, another $53,000. That's about $148,000 in combined taxes. The higher your state tax rate, the more valuable step up becomes. Alright, let me walk you through the exact framework I use with clients when they are deciding whether to gift now or wait. It's simple, it's logical, and it forces you to think through the tax consequences before making a permanent decision. Step 1. What's your estate size? This is the starting point. If your estate is under 15 million exemption or 30 million merit, you usually lean strongly toward waiting for step up. If your estate exceeds the exemption, then gifting now becomes a real strategy for reducing estate tax. Estate size sets the stone for everything else. Step number 2. How much has the asset appreciated? Look at the gain. If the asset has a massive gain, 5-10 times what you paid, waiting is almost always the smarter move. If there is little or no gain, then gifting now is generally safe because there is no meaningful capital gains risk. Appreciation tells you how big of a mistake you might be making. Step number 3. What will your kids do with the asset? This is an overlooked but essential question. If they will sell it shortly after inheriting it, step up is incredibly valuable. If they plan to hold it for life, the timing matters less, though step up at inheritance is still a gift to them. These intentions impact the tax consequences, not just yours. Step 4. What type of asset is it? Not all assets behave the same. Rental real estate with depreciation, step up wipes out the recapture, so waiting is usually best. Cash, there is no basis issue. You can give that freely. Highly appreciated stock, almost always better to wait unless you have an estate tax problem. The asset class itself changes the answer. Step 5. Are you in good health? This isn't fun to think about it, but it matters. If you are healthy with decades ahead, you probably wait. If you have health concerns or advanced age, it may be worth reassessing your plan with your advisor. Step up is the most powerful when time is on your side. This isn't about being perfect. It's about being strategic and avoiding the big costly mistakes. The ones that quietly rob your kids of $50,000, $100,000, sometimes even $300,000 in unnecessary taxes. A well-timed gift can be incredibly generous. A poorly timed gift can be incredibly expensive. And this is exactly where personalized planning matters. If you're looking at your own portfolio and wondering, should I give this now or wait? Let's talk it through. I offer complimentary estate clarity meetings where we can discuss your situation, your estate size, your assets, your goals, and see if it makes sense to work together on a comprehensive strategy. No pitch, no pressure, just a conversation to see if we are a good fit. I'll leave a link in the description below if you'd like to schedule a time. And if you're wondering what other tax rules come into play when you gift assets beyond just basis, I've got a video that walks through the gift tax traps most parents miss. It's a great follow-up to this conversation.